The majority of Canadian mortgage borrowers have or will break a mortgage before the end of the term. When the mortgage is broken, normally a penalty fee is paid by the borrower to the lender, and the borrower is then free to renegotiate the terms of the mortgage with any lender they wish. In most cases, the mortgage is broken for beneficial reasons. We'll discuss some of these a little later in the video, but to begin with, we're going to look at the most common reason borrowers break their mortgage, which is to save money with a lower rate when a lower rate becomes available. So how do you determine if you're going to save money by breaking your mortgage for a lower rate? Well, let's look at an example. Let's say a borrower has a mortgage with an existing balance of $250,000 with a current fixed rate of 3.49%, with 4 years or 48 months remaining in the term, which means the mortgage matures in 4 years. And the penalty to break the mortgage is $2,181, which is based on 3 months interest. It's important to know, though, that when it comes to fixed rates, lenders will use the greater of 3 months interest or an interest rate differential, so the penalty could be larger than 3 months interest. Now, back to our example, let's say that a fixed rate of 2.99% is now available for a term of 4 years or greater, which is lower than the borrower's current rate. The reason I mentioned 4 years or greater is because there are 4 years left in the term in this example, but the trend in Canadian mortgages at the moment is for lenders to offer lower 5-year fixed rates than they offer for 4-year fixed rates, which is great because adding an extra year to your term can actually protect you from rising rates in the future. So how do we know if this borrower can save money? Well, if the difference in interest cost over the remainder of the term between the current rate and the new rate exceeds the amount of the penalty, a savings is achieved. So let's go to the comparison calculator. So at the top of the calculator in the yellow box, we have the borrower's current mortgage details. First, we'll take the current balance and carry it into Table A. Then we'll do the same with the interest rate, the monthly payment, and also notice that the time period for the calculation will be 48 months in all fields. So their current mortgage at the end of the term will have a remaining balance of $223,004 with a total of $32,860 paid in interest over the 48-month period. Now, you can see that I'm leaving the debt section in Table A empty. We'll get to that later. Now we're going to bring the beginning balance into the total of the current balances section. We'll also bring the penalty down to the plus penalty section and add the two together to get a new balance of $252,181. You see, in this calculation, we're adding the penalty to the mortgage so the borrower doesn't have to pay the penalty out of pocket. When you're not increasing the mortgage beyond the penalty, in most cases, a lender will classify the transaction as a switch, which will allow you to capitalize the penalty in this manner. With a switch, the lender also pays the legal fee for switching the mortgage over to them, so there's no legal fees to account for in this calculation. So let's carry our new balance into Table B of the calculation. We've inputted the new available rate of 2.99% into Table B, and we've taken the borrower's current total monthly payment and brought it into Table B as well. The result in Table B is an ending balance of $220,493 with paid interest of $28,168. Now we carry the total ending balance in Table A and we'll subtract the total ending balance in Table B, which gives us a total savings of $2,511. So now, what if you have debts other than your mortgage with interest rates higher than the mortgage rate available? Current mortgage rules allow you to increase your mortgage up to 80% of the market value of the home. So if you have equity available, you should calculate what savings can be achieved by increasing your mortgage to pay off these higher interest debts. So let's include a credit card and a personal line of credit in the calculation. So first, let's say that the borrower has $10,000 owing on a credit card at a rate of 12.99%, as well as a line of credit with a balance of $20,000 at a rate of 7.5%. After 48 months, the total still owing on the mortgage, credit card, and line of credit will be $231,931, which will carry down to the bottom of the calculator. So just as we did in the first part of the example, we'll carry the total current balances of the mortgage, credit card, and line of credit down into the total of all current balances section. And with the penalty added, we get a total of $282,181, which will bring into balance 1 of Table B. By consolidating all the debts into one debt at a rate of 2.99%, our ending balance after the 4-year period is $223,733. Subtracting the ending balance from Table B from the ending balance in Table A, we get a total savings of $8,197. With a debt consolidation like this one, the transaction would be classified as a refinance, so a legal fee would be paid. In this example, we'll use a legal fee of $1,000, although we can generally get lower pricing than $1,000. You can either add the legal fee to your mortgage or pay it out of pocket. The choice is yours. So the total savings in this example is $7,197. one thing to note is that the larger the numbers are, the more savings can be achieved. For example, if you have a mortgage that's double the size of the mortgage in this example, the savings would be double as well. And the same goes for credit cards. The larger the credit card debt, the more savings can be achieved. So let's talk about the savings target rate. Rates fluctuate. So every week I'm going to release a short video that will provide a savings target rate. And basically, using the same calculation as we discussed in the first part of the example, I'll provide you with a rate which, as it states below, if you have a mortgage with a rate higher than this rate, you are likely in a position to save money. In the example we discussed, the target rate would be about 3.49%, but it was just an example. So please check for my latest savings target rate video to see if the rate is lower than your current rate. If your rate is higher than the current savings target rate, please feel free to contact me by email, message me through my website, or even leave the following details in the comments section and I'll calculate the savings for you. So what I'll need to know is the current balance of your mortgage, the current interest rate of your mortgage, whether it's a fixed or variable rate, the maturity date of your mortgage, the original term of your mortgage, for example, a 5-year term, the monthly, biweekly, weekly, or semi-monthly payment of your mortgage, and the name of your lender. So, for example, something like this would be fine. And if you have other debts other than your mortgage, please let me know the following for each: the current balance, the current interest rate, the minimum monthly payment, and the name of your lender. So thank you for watching, and if you have any questions, please feel free to contact me or leave your question in the comments section, and have a good day.